Imagine you have $1,000 and put it all into UnitedHealth Group in 10 years. Will it turn into 10,000 or flatline? Our study shows the max potential can goes up to 5.2x. We're going straight to the 10K to find out the hidden engine. All right, let's break down UnitedHealth Group. Looking ahead, 10 years into the future, to 2035. The big question, is it a good investment? First, let's set a benchmark. The Vanguard S&P 500 ETF, you put in $1,000. After 10 years, you could get back over $3,145. That's a 3.1 times gain. Now, let's look at the Invesco QQQ Trust, the tech index. Put in that same $1,000, it could become over $4,211, a 4.2 times return. So that's the competition. Now, for UnitedHealth Group, we are going to deep dive into the numbers behind the valuation. We used a few methods. First, we project its cash flow, the cash flow projection. Based on that, your $1,000 investment could grow to almost $4,188, a 4.2 times return, almost matching the QQQ. Then, a second method, looking at core earnings, the EBITDA projection model. Your $1,000, it yields $3,886, so a 3.9 times return. And the third method, based on dividends, the dividend projection. With this one, your $1,000 could turn into roughly $5,236. That's a huge 5.2 times gain. So you have three different numbers. What's the takeaway? We averaged them out for a final projection, and the result, over the next decade, an investment of $1,000 in UnitedHealth Group is projected to become nearly $4,433. That's a potential 4.4 times multiple, a very strong performance. One day, one stock. Today, we'll look into UnitedHealth Group. Welcome to Stock Snack. All kind of financial numbers could be overwhelming. At Stock Snack, we help to analyze stock, if they are good or bad. At Stock Snack, we help justify it and present it to you. Fast and joy, like having snack. Subscribe now to find the simple truth in complex reports. Today, we will go break things down into 4 parts. First, we had go through the price projection and had identified the current price listed in market is a bargain or not. Second, we'll go through the qualitative analysis. This is to gain some basic info of the company. For example, who are they? What are they selling? Who's their competitor, etc. Third, we will go through the business segment analysis. Identify what's their main business. Fourth, we will go through financial statement checklist to identify the financial health of the company. Want to skip ahead? The description has a timeline for easy navigation. You can also find the tools and resources I used to create this video there. All right, let's get into the company basics. This is the background story. You see, the core business is simple. It's diversified healthcare services and, of course, insurance coverage, a huge global operation. The story starts in Minnetonka, Minnesota. Way back in December 1974, that's 50 years ago. It started as Charter Med, just processing claims. The company grew quickly through acquisitions. A key moment was January 1995. They bought Mitra Health. This instantly and significantly expanded their employer base. Then came the Medicare push. December 2005, they acquired Pacific Care. This gave them a massive boost, especially in the senior market and on the West Coast. The biggest shift was April 2011. They launched the Optum brand. This wasn't insurance. This was the Tech and Health Services division. It changed everything. A more recent milestone was October 2022. They acquired Change Healthcare, a massive purchase for technology and data. This acquisition bolstered their health technology platform, and going way back, the foundation for all this expansion. The initial public offering, the IPO, was in October 1984. That's over 41 years of public trading. Now, where are they? They are primarily focused on the United States, but their global footprint is massive. They operate in over 150 countries. The industry is complex. It's managed healthcare, it's health insurance, and it's a huge, growing part. Technology-enabled health services. So, who do they sell to? It's a hybrid model. It's B2B selling services to hospitals. It's B to C selling plans to you and me. And it's B to G handling government programs like Medicaid. Finally, the revenue drivers, the products making the most money. Number 1 is the main insurance arm, UnitedHealth, bringing in nearly $300 billion in total premiums. But close behind is Optum Rx. That's the pharmacy benefit management side. They handle prescriptions for everyone. And then there's Optum Health. That is their direct patient care. It's a diversified powerhouse. That's the whole picture. All right, now we get to the real fight, the competitive landscape, the sheer market power. First, let's look at the top revenue titans, the giants of the industry. At number 1 is our focus, UnitedHealth Group. Revenue is huge, about $400.3 billion. Their main product is UnitedHealthcare. That's the core insurance business. Number 2, CVS Health Corp., a massive rival in size. Revenue is $378.9 billion. They combine retail pharmacy stores with Aetna Health Insurance, a totally integrated model. Third, McKesson Corp., $308.9 billion. They are different. They specialize in pharmaceutical and medical distribution. They control the supply chain flow. Fourth is the Cigna Group, $247.1 billion in revenue. Their main driver is Evernorth. That's their PBM and health services arm, their Optum equivalent. And number 5 is Elevance Health, $177 billion. They focus on commercial and government health plans. The essential policy seller. Now, let's focus only on direct rivals, the ones with the most similar business style. The ones trying to be the next UHG, top rival is still CVS Health Corp. Revenue is massive at $384.3 billion. They put Aetna health plans together. With their own CVS Caremark PBM, total patient control. Second, the Cigna Group, $262 billion in revenue. They marry Evernorth's services the data and PBM with their Cigna Healthcare. The integrated approach is key. Third, Elevance Health, $177 billion in revenue. They are building out Carelon services. This is their technology engine to support their core Blue Cross Blue Shield plans. Fourth, Centene Corporation, $163.1 billion. They focus on government programs, specifically Medicaid and Medicare plans, a very specialized B2G dominance. Fifth is Humana Inc., $117.8 billion. Their focus is seniors, Medicare Advantage plans, and they are growing CenterWell primary care. They are buying physician practices, so you see the trend. Everyone is building a version of the diversified insurance and services model. It's an ecosystem war. All right, let's get into the deeper stuff, the qualitative picture. So let's talk about the management team, the people running the show. The general feedback is split. Management drives very strong financial growth year after year. But this happens despite major ethical controversies and intense public criticism. It's a tough balance. Next, the existing business frontier. Where are they focusing right now? They are accelerating value-based care. This means paying for health outcomes, not just services. And they are pushing digital health plus constant expansion of Optum's services integration. That's the current battleground. Now, their competitive advantage, what is their secret sauce? It's their integrated scale. And the deep data they get from Optum, this creates unparalleled value. It's a powerful feedback loop competitors cannot match easily. The overall industry trend, it's defined by them. It's vertical integration, buying up doctors and pharmacies. It's shifting care to value-based models, and huge exponential growth in digital health and AI. The entire sector is moving this way. So, what's their future direction? It's pretty clear. It's all about expanding Optum's integrated care delivery. More doctors, more clinics, using technology and data more deeply. To better manage health outcomes, that is the long-term play. All right, let's break down the revenue machine. The growth story is fascinating. It's a tale of two segments. First, UnitedHealthcare. This is the insurance arm. In 2017, its revenue was about $163 billion. By 2024, it hit almost $298 billion. That's massive growth. The compound annual growth rate is 10.6%. above our 2 times inflation benchmark. But listen to this. Its contribution to the total company revenue is actually shrinking. It dropped by 6.7%. It's still the biggest part, but another segment is catching up. That segment is Optum. This is the services arm. In 2017, Optum revenue was $91 billion. By 2024, it surged to $253 billion. The growth here is staggering. The CAGR is 18.5%, way above our benchmark, and its share of the total company revenue. It grew by almost 18%. Optum is the true growth engine. It's driving the future. Now, let's look at revenue types. The product's revenue, things like physical pharmacy products, it went from $26 billion to $50 billion, a solid growth rate of 11.3%. But the real focus is services revenue. This is the consulting, the tech, the data. It grew from $15 billion to $36 billion, a strong CAGR of 15.3%. Its share of company revenue is expanding. And finally, the hidden gem, investment and other revenue. This jumped from just $1 billion to over $5 billion, an explosive 31.1% CAGR. It shows their capital management is extremely effective. So, the big takeaway, UnitedHealthcare brings in the sheer volume, but Optum brings the speed. And the future margin, that's where the investment focus is going. Okay, let's talk profit. The operating income breakdown. This shows where the company truly makes its money. We are measuring growth against our 2 times inflation benchmark. It's a high bar. First, the profit from Optum. This is their service engine. In 2017, income was almost $7 billion. By 2024, it hit over $16.7 billion. That's a huge surge. The growth rate is 16.4% annually. This is clearly above the benchmark. And its share of total profit grew to 51.8%. Optum is now the main profit engine. Now, look at UnitedHealthcare, the insurance business. In 2017, its profit was $8.5 billion. By 2024, it grew to $15.6 billion. The annual growth rate is 7%. This rate is still above the 2 times inflation benchmark. But the key insight, its contribution to the company's total profit actually shrank. It dropped by 7.7%. It is no longer the majority profit center. So, the big picture is clear. Optum is where the profit momentum is. The model transition is complete. Services drive profits. Insurance provides scale. That is the future strategy working. Do you ever just drown in endless browser tabs, manually extracting data just to do a basic analysis on a stock? I used to, until I found this incredible site at stockanalysis.com. You can essentially do it all in one tab. It's fantastic. You can go from using their screener to find new ideas, to creating your own watch list, to checking the full trend of metrics in a company's annual reports. And the best part, the core platform is completely free. If you're ready to take the next step and seriously streamline your workflow, you can subscribe to their Pro package. This is where you unlock crucial features, like the ability to extract all that data into Excel. For custom modeling, the Pro plan is shockingly affordable. It works out to be less than $1 per day. That's institutional-grade data for the cost of pocket change. Feel free to drop a visit to the site. And if you decide to upgrade, make sure you subscribe with the code StockSnack to get a 10% discount. Okay, now for the final check. The financial health of the company. First, let's highlight a crucial step. We've go through 3 main statements in the annual reports, namely the balance sheet, the income statement, and the cash flow statement. Each we analyze multiple metrics to access if it is healthy. This will be discussed later. Right now, we will provide an overview to get a top-line insight first before a deep dive. So, the summary of health. Let's start with the latest metrics, the most current snapshot. The balance sheet looks rough. We checked 6 metrics. Only 1 was good. That's a 16.67% score. That is bad. The income statement, 8 metrics checked. For good, for bad. 50% score. This is also bad. It's just average performance. But the cash flow statement is strong. For metrics checked, 3 good, a 75% score. That is good. The cash flow is reliable. Now, let's look at the long-term average. The last 10 years, The balance sheet improved over time. 60% good score. This moves it to good. Stability over the long haul. The income statement stays the same. Still 50% good score. Still considered bad, the cash flow statement is excellent. 83.33% good score. Very good over 10 years. Finally, the 5 key attributes. The rational investing check. Revenue growth is strong at 8.8%. Above the 2 times inflation benchmark, good EBITDA growth is also good at 7.5%. Again, above the inflation benchmark. Good. Strong free cash flow is 8.2%. Above the inflation benchmark, good debt to EBITDA is low at 240.8%, below the 300% benchmark. Good. Low debt risk. And finally, well-priced stock. The projected return is 18.4%, above the QQQ benchmark of 17.95%. Good. The valuation looks very attractive. Overall, strong investment opportunity. But with financial risk flags, we need to discuss those later, right sources? Okay, time for the deep dive. We are looking at the balance sheet. This tells us the health of their finances. It's about assets versus liabilities. We use simple rules of thumb. First, cash versus debt. The pointer is simple. Cash should be more than total debt. The ratio should be above 1. In the 2024 report, the ratio is 0.71. That means less cash than debt. This is bad. The 10-year average is 0.8, still below 1. Bad long-term, too. They rely on borrowing. Second, debt to equity. We want this below 80%. It means the company mainly funds itself with equity, not excessive debt. In the latest report, it is 83%, slightly over the line. Bad, but the 10-year average is 74%. So, historically, this part is good. Third, preferred stock. The rule, it should be 0. Good companies don't need expensive preferred stock to raise money. It is 0%. Good. This shows healthy fundraising power. Fourth, retained earnings growth. This measures their ability to compound capital, especially during tough times. The growth rate is 11%. That is strong. Good. Fifth, treasury stock. This tracks share buybacks. It shows management returning cash to shareholders. The amount is 0. Bad. They aren't signaling direct value return through buybacks. Sixth, return on equity row. We want this above 25%. It shows efficient use of shareholder money. The latest row is 16%, well below the benchmark. Bad. The 10-year average is 22%, still not hitting that 25% mark. Bad. Seventh, return on total assets. ROTA. This tells us how well they use all their assets to generate profit. We want it above 10%. In 2024, it's 9%. Bad, but historically, the 10-year average is 13%. So, over the long run, this is good. The summary. The latest balance sheet has warning signs. Cash coverage and asset efficiency dropped recently, but historically, they are stronger. The debt situation needs monitoring. Definitely. All right, we are looking at the cash generation, the quality of their profits. We use simple rules of thumb. This benchmark tells us if the company has healthy financial discipline. First, gross profit versus revenue. We want this ratio above 40%. That shows they have strong pricing power. UnitedHealth is only 22% now. The long-term average is 24%. This is bad. It signals their core costs are very high. Next, selling efficiency. This compares sales costs to gross profit. We want this below 30%. It means the product sells itself easily. UnitedHealth spends 59%. Bad. They spend a lot to run the business. But look at R&D spending. It's 0% of gross profit. This meets our simple business benchmark. Good. They aren't pouring money into risky, unproven research. Now, let's talk about debt servicing. How easily can they handle their debt interest? The interest expense should be below 15% of operating income. Lately, it's 12%. Good. The 10-year average is 9%. Also good. They are easily meeting their interest obligations. However, the final net income margin, we look for 20% profit on every dollar of revenue. UnitedHealth currently gets 4%. Bad. This reflects the thin margins of the highly competitive insurance sector. Despite the thin margins, income per share has grown 11% annually over 10 years. Good, the company is compounding value reliably. That is the critical takeaway. Now we move to the final piece, the cash flow statement. This is crucial for assessing true financial health. We look at cash in, cash out. We use special rules of thumb. First, stock-based compensation. We want minimal dilution of shareholders. The compensation given as stock should be low relative to revenue, ideally below 30% if growth is high. UnitedHealth's rate is extremely low, 0.25%. Good, this means their management pay is barely diluting your shares. Second, operating cash flow versus net income. Operating cash flow should be higher than net income. This confirms that reported earnings are quality earnings. Lately, the ratio is 0.6. Bad, the 10-year average is 0.72. Still bad. This means their accounting net income is higher than the actual cash the business generated. Third, free cash flow growth ratios. We compare the growth of free cash flow to net income growth. A ratio near 1 or above means cash earnings keep pace with reported earnings. The annual ratio is 0.9. Good, the 10-year CAGR ratio is a clean one. Good, this suggests that while the magnitude of cash flow is lower, the growth is healthy and consistent with their reported profits. Fourth, capital expenditures versus net income. How much cash are they pouring back into the business? We want this below 25%. It means they are efficient with their capital spending. The latest number is 24.29%. Good. The long-term average is even better at 16.89%. Good, they don't need excessive capex to grow. Finally, shareholder returns versus free cash flow. Are they spending all their free cash on dividends and buybacks, or leaving cash for future growth? We want returns to be below 100% of free cash flow. The latest figure is 70.93%. Good. The 10-year average is 49.31%. Also good. This confirms they are retaining significant cash for future investments. They are funding growth? What do you think? Overall, the cash flow shows financial discipline, minimal shareholder dilution, strong capital efficiency, but a slight concern about the quality of reported earnings versus real cash flow. Comment your thought below. So, here is the final verdict. We covered everything. From the business model to the raw numbers, the valuation is good. The average projection is an 18.44% annual return. It beats the S&P 500 and the QQQ. The stock price looks cheap right now. The qualitative analysis is also good. The company dominates the industry. They are vertically integrated. Their Optum business is the key future driver. They are focused on the powerful value-based care trend. The business segment analysis is also good. The Optum division profit is growing faster. It now generates more operating income than insurance. The model transition is succeeding. Now the financial checklist results. The overall latest metrics score is bad. The balance sheet has flags. Cash versus debt is a concern. The income statement is average, but the 10-year average looks better. The balance sheet is stable. Cash flow metrics are consistently good. The 5 key attributes, check. It's all green, good growth, cash flow, debt management, tall, strong, and the stock price is compelling. This means you have a company with a great long-term growth story driven by a unique integrated business model. But the recent accounting snapshot shows volatility and room for operational improvement. It's a high-reward play. This doesn't mean good or bad for the stock. It's just an analysis, and different people have different opinions and risk behaviors. Comment below to let us know what you want to deep dive for next.